Most investors get this completely wrong. They pick one loan type, either conventional or DSCR, and they ride it the whole way. And honestly, that single decision is the reason most real estate portfolios stall out between 3 and 5 properties. I'm going to break down exactly how conventional investor loans and DSCR loans actually compare. Qualification, scalability, costs, and more importantly, I'm going to walk you through the specific moment in your portfolio growth where you should switch from one to the other. And there's a scenario toward the end of this video involving an investor I worked with who figured this out almost too late. That one's going to change how you think about your entire financing strategy. Quick heads up, if you're an investor trying to figure out the right financing strategy for your next deal or your overall portfolio, I have a link in the description where you can schedule a free strategy call. I'll look at where you are and map out the path that makes the most sense. Most lenders give you a rate, I give you a strategy, and today's no different. Okay, so let's get into it. Conventional investor loans are the starting point for almost every rental property investor, and for good reason. They follow Fannie Mae and Freddie Mac guidelines, which means you're getting the most competitive pricing available for investment properties. The trade-off is how you qualify. The lender's looking at you, not the property. Your W-2s, your tax returns, your debt-to-income ratio. All of that is front and center. And here's the part that people don't think about early enough. Every single rental property you add gets stacked onto your personal DTI. So property number 1 feels easy. Property 2, still fine. But property 3 or 4, even if every single one of your rentals is cash flowing, your DTI on paper might be creeping toward that ceiling because of how rental income gets calculated on tax returns, especially if you're taking depreciation and write-offs like a smart investor should. Let me ask you something. Have you ever had a property cash flowing great in real life, but looking like a loss on your Schedule E? Yeah, that's the conventional loan trap for investors. The math on your tax return doesn't match the math in your bank account. Now, here's where DSCR loans enter the picture, and honestly, I think this is the most misunderstood product in real estate investing right now. DSCR stands for Debt Service Coverage Ratio. Instead of looking at your personal income, the lender looks at one thing. Does this property's rental income cover the mortgage payment? That's it. No tax returns, no W-2s, no employment verification. The property has to pay for itself. A DSCR of 1.0 means the rent exactly covers the payment. Most lenders want to see somewhere around 1.0 to 1.25, though it does vary. And because qualification is based on the property, not you personally, your DTI is completely irrelevant, which means each deal stands on its own. You could have 15 finance properties and still qualify for a number 16 as long as that specific property cash flows. Now, compare that to conventional, where Fannie Mae caps you at 10 total finance properties. And honestly, most investors hit a practical wall before 10 because their DTI maxes out first. Actually, let me back up on that for a second. The 10 property cap with conventional, that includes your primary residence. So if you've got your house financed plus a vacation home, you're already down to 8 slots for rentals. And once you get into the 5 to 10 range, the underwriting gets significantly more complex. Higher reserve requirements, fewer lenders willing to do the deal, more documentation. Now, I've had investors come to me at property number 6 completely stuck, not because they didn't have the money, but because no conventional lender wanted to deal with the file. Okay, what I'm about to walk through is the part that changes everything. If you've been following along, this is where it all clicks. The savviest investors I work with don't choose between conventional and DSCR. They use both, strategically, at different stages. Here's what that actually looks like. I had an investor, let's call her Maria, who came to me with 2 conventional finance rentals, solid W-2 income, great credit. She wanted to buy properties 3 and 4, and I told her to use conventional. You've got the room in your DTI, you'll get better pricing, take advantage of it while you can. She picked up 2 more single-family rentals on conventional terms. But then she wanted property 5, and this is where it got interesting. Her DTI was right at the edge. She'd also started a side business that year and had taken a bunch of deductions so that her taxable income actually dropped even though she was actually earning more. Conventional underwriting looked at her tax return and said, nope, the numbers don't work. But the property she found, beautiful cash flow, rent more than covered the proposed payment, We pivoted to DSCR, no tax returns needed, qualified based on the property's income, closed in about 3 weeks. And from that point on, every new property she acquired was DSCR because her conventional runway was used up. She kept those first 4 conventional loans locked in at their rates and then scaled the rest of the portfolio with DSCR. That's the playbook. Conventional builds the foundation because you get the best available terms when the personal finances are clean and your property count is low. DSCR is the scaling tool. It removes a ceiling on your growth. If you're an investor trying to figure out the right financing strategy for your next deal or your overall portfolio, let's talk. Schedule a free strategy call. The link is right below this video, and I'll look where you are and map out the path that makes the most sense. Now, let me give you a few more differences you need to know because the details matter. Conventional loans are subject to conforming loan limits. Currently, that baseline sits at $832,750 for a single-family property in most areas. DSCR loans? No conforming limit. They're non-QM products originated by private lenders, so the loan amounts can go much higher depending on the property and the lender. And that matters a lot if you're investing in higher price markets. Another big one is entity ownership. If you want to hold your rentals in an LLC for asset protection, which frankly every serious investor should be thinking about, conventional loans make that very difficult. Fannie and Freddie want personal ownership. DSCR loans are built for entity vesting. Closing in an LLC is standard, even encouraged. And closing speed? Conventional investors can take 30 to 45 days, sometimes longer if you're in that 5 to 10 property range with all the extra documentation. DSCR loans commonly close in the 21-day range because the file is simpler. When you're competing for a deal in a hot market, 2 weeks can be the difference between getting the property and losing it. So here's the bottom line. If you're early in your investing journey, first couple of properties, strong W-2 income, clean tax returns, use conventional. Now, get those favorable terms while you still can. But build that strategy knowing that conventional has a ceiling. And when you hit it, whether it's the DTI wall or a property count limit or a tax return that doesn't tell the real story, DSCR is how you keep going. The investors who build serious portfolios are the ones who understand that these aren't competing products. They're complementary tools. And knowing when to use which one is genuinely what separates someone who owns a couple of rentals from someone who builds real wealth through real estate. If this helps you see your situation differently, do 2 things. Schedule a free strategy call using the link in the description. I'll personally look at your numbers and help you build the right plan. And then hit that subscribe button so you don't miss what's coming next. Talk to you in the next one.